All right, welcome all to our next meeting for our farming fundamentals class. Thank you guys for joining us online tonight. Hopefully we don't have too many people showing up at the Ag Park for an in-person class tonight, but we're getting a little bit closer. We're getting some of these wrinkles ironed out. But this one's a work from home night, but it's one of the better nights. I think one of the more enjoyable nights you'll find is. It's not necessarily the topic that everybody wants to talk about. It's a topic everybody needs to talk about from lots of different perspectives. Of course, we've got quite a wide range of people involved in this, from a backyard garden and an acre, trying to figure out what all things can we operate with, to hundreds of acres and cattle. So I think our speaker and our topic tonight is going to probably hit home for a lot of you in all different areas, whether it's just your personal income and personal things that you do for your regular life as well. So it's my privilege to welcome Mr. Alan Galloway. Alan is one of our farm management specialists, and we have some of these situated all across the state. So I know some of you are from different parts of the state or have farms in different parts of the state. And so we have these positions all across the state, and some have a little bit more of a focus on some certain areas and others on other different areas. And so, Alan, we are very lucky to have Alan in our central region. Alan serves as not only the farm management specialist, but also really as the expert when it comes to taxes, income taxes, and a lot of estate management. And so they've developed a really, really cool, another program, kind of like Farming Fundamentals, around estate planning, and a really great resource library that maybe he'll talk a little bit as we go through here. That's just top notch. So I know that crosses the paths for quite a few of you. We get a lot of questions all throughout asking about some of these things. And so tonight's a great program to kind of highlight some of those. And obviously, if we need to get further in depth, Alan, and we'll talk about a few others that are involved in our area that we can link you to, can help us dive a little bit further into your personal situation. So, Alan, I'm going to turn it over to you and let you head from there. I appreciate it.
All right. Thank you, Matt. I will attempt to share my screen, and let me see if I can get it pulled up here so we can see the slides. Getting the buttons clicked right is always the challenge. All right. If you got it, if I got it showing up there, Matt? Okay. As long as we're good. Yeah. Thank you, sir. Folks, as you will find out, I've got a lot of ground I'm going to try to cover tonight in a fairly short amount of time. I hope to touch on a lot of topics that will assist you in a general knowledge related to farm income taxes and other taxes that you have to deal with as a farm owner, farm producer. As you can see, I've got my email address listed there. I cover, you might say I call it the northeastern part of Middle Tennessee. I've got, Macon, Trousdale, Smith, you might say east and north of the I-40 pretty much. But I'm willing to answer questions at any time. So if you run into tax questions later on and want to kick me an email, I don't mind trying to answer them. And if you want to get more involved with a farm financial planning, then we've got, as Matt said, a lot of area specialists scattered across the state that assist farm families on a lot of different farm financial planning type topics. So we're always glad to assist you with those. As you'll find, I'm from a little further east than where I'm in Cookeville right now, but I grew up about 50 miles east of here on the Cumberland Plateau. I tend to talk fairly fast, and I may leave you behind on some of these topics. So jot a note down. I probably won't be able to see the chat box or anything while we're talking, but if you got questions, I'll save some time at the end, hopefully to fill in a few blanks on that. But as you'll find, I've got a lot I'm going to try to cover tonight. First off, I got to throw in a little disclaimer. I'm not a CPA. I don't do taxes for a living. That said, I have assisted in teaching tax workshops or tax schools for the last 15 years to CPAs and tax preparers. And in a lot of those, a lot of times I have to spend time explaining farming. because they're accountants and they may not understand farming that well. So I have to kind of run the middle ground between explaining what they have to do in preparing taxes for farmers and try to get them on board, you might say, a little bit that way. But tax laws change frequently. And nobody, and I mean nobody, fully understands all the tax code because it's just too complicated. And so I always say, if you've got specific questions, you may need to ask your tax preparer that you use to help do your taxes, or, just do a little bit of digging yourself. You'll find the IRS website is actually fairly user friendly, and thank goodness it's there, because trying to call them and ask a question these days is just darn near impossible. They're woefully shorthanded and still have a horrible backlog, even from 2019 and 2020, with folks on taxes that haven't been completely settled yet. All right, first off, I want to throw in a little quick public service announcement, just because I like to. For one thing, just to remind you folks, there's an 811 call system out there to help you be safer. I met a group of folks working with the Pipeline Ag Safety Alliance a few years ago. They're a nonprofit that strictly exists to help farmers stay safe. And they just want everybody to watch out for underground utilities, gas lines, anything like that. So anytime you're putting in fence or digging up roots or stumps or whatever, think about what's there and make sure, just call 811. They'll come out within 3 days, mark it for you, make sure there's no dangers. That's worth a whole lot of comfort knowing that anyway. All right, that's my public service announcement. All right, talk just a little bit about records. Number one, records, obviously, you got to have them to do your taxes. That's important right off the bat. But a lot of times you think about the records and how you're going to hand them over to your tax preparer, or if you're doing your taxes yourself, having a good set of records to work from makes life a whole lot easier. And tax preparers are professionals, whether it's a CPA or an enrolled agent or whatever their certification may be as a tax preparer. They're going to charge you based on how long it's going to take them to do your job for you, how long it's going to take them to complete the tax forms for you. So the better job you do giving them good records, the easier it is for them, the quicker they can do the job, and hopefully it'll reduce the cost a little bit of getting that tax preparation done. I always remind folks, if you're doing farming, it's good to find a CPA or tax preparer that actually understands farming a little bit, and that gives them a heads up a little bit, or an advantage of trying to do your taxes and make it as accurate as possible, and hopefully save you money in the long run. And of course, I always like to say that the best record keeping system out there is one you'll use. If it's the fanciest, you can have the fanciest computer software in the world, but if it's too confusing for you and you just don't want to use it, it's not going to help you much. So, an old composition book might be better if you're not going to keep it any other way. But anyway, that said, records are critical. Let's get into what I'm going to talk about tonight. And I won't read this list to you, but as you can see, I've got a fairly lengthy list of topics I'm going to touch on related to income taxes and other taxes that relate to the farm. I'll throw in a little quick one here about my little cartoon there that has E-I-E-I-O, McDonald. I left the O off because the whole idea here is to owe as little as possible legally to the IRS when you're all done doing your taxes. So hopefully I can point out some tips or tidbits tonight that might save you a little bit, or at least bring your level of understanding up a little bit related to taxes. All right, let me jump into some current issues, things to talk about, what's going on right now in 2022, and some that kind of hit us in 2021 a little bit too, because a lot of us are doing our tax returns right now. I was talking to one young couple the other day that had already gotten their refund. So, they filed electronically. It was a fairly simple return, evidently, and they've already gotten their money. So I was tickled to hear that the IRS is at least on those returns getting the refunds out pretty quickly. Standard deduction, this is for 2022, not the 2021 taxes that you're completing right now. So this will be your standard deduction for this year. Single, $12,950. MFG stands for married filing joint, or for couple. 25.9 is your standard deduction, and HOH is head of household, which has the 19.4 this year. Well, a little bit about our tax rates, kind of where do we end up with tax rates? And you talk about the different tax brackets. And the values or the dollar amounts that they give you is adjusted gross income. So it's not total income, it's the adjusted gross income that you're taxed on. So the 10% bracket, and I'll just read the married filing joint lines over there, $20,550 is your standard deduction. So unless you're making, up to that much, you're not going to pay over 10% on your taxes total. And of course, you have a minimum amount anyway. 12% goes up to 83,550. 22% you can see way on up to 178,150. And there's brackets above that, the 24, 32, 35, 37% brackets. And I always say, if you're in those, I'm real proud for you, because you're paying some taxes, yes, but at the same time, you got a pretty nice income too. So that's not a bad place to be. Well, let's talk about a couple little new things. On your tax return you're doing right now for 2021, they added a charitable giving donation deduction. Now, in the past, you didn't get hardly any credit for charitable donations. And I mean, charities like your rescue squad, your volunteer fire department, the church that you give to, all of those nonprofits, those 501c3s or those type organizations that you may donate money to during the year, you typically didn't get any credit for that on your taxes for the last few years unless you were able to itemize your taxes. Well, with that standard deduction up in that $25,000 range, most folks don't have enough itemized expenses to be able to itemize, unless they're just, just really well-to-do and are giving a whole lot to charity or whatever, or have other major medical expenses or something like that. So they passed a law in last year's taxes where you could get up to a $300 deduction for cash donations. Now, if you donated clothes to Goodwill, that didn't count. So it had to be cash donations. Well, last year it was $300 for a couple or $300 for an individual, which obviously wasn't quite fair. So they came back, and on your 2021 tax return you're doing right now, if you had charitable donations, you can get a deduction of up to $600 for a couple, married, filing joint, or $300 for an individual. So that was kind of a nice break. So like I say, it has to be cash donations, but it's a nice little deduction. So if you're at that $600 level and you're in the 10% tax bracket, that just saved you $60 on your taxes. The other biggie that has confused a whole lot of folks this year is our child tax credit. It was a really nice one. They bumped it up last year to $3,000 per child, or $3,600 for every child under the age of 6. And then in their infamous wisdom, Congress decided, well, hey, let's give you some of that credit in advance. So what they started doing, and many of you that's got kids, you understand this only too well, from July to December of last year, they issued either through direct deposit or through checks, either $250 or $300 per month for each of those children. That provided you with 1/2 of that $3,000 or $3,600 for those children. And families should have received letters that were numbered number 6419 from the IRS. And you got those per person. So a couple, both parties of the couple, the husband and wife, whatever you're gonna say, each got a letter stating they're part of that money that was that child tax credit that they got in advance. Now, of course, you could have gone online and opted out of receiving that monthly payment, and a few folks did that, but it was a hassle to do that. So a lot of folks didn't bother with it. So basically, when you're filling out this year's tax returns for the 2021 return you're doing now, you're going to get the other half of that credit, and it'll come through to you. If you had a child born in 2021, the IRS doesn't know about them. So that child is obviously under age 6. So you'd get the full $3,600 for that child. In one return I was talking with somebody with the other day, they had a child born in 21. They were getting that $3,600, but that $3,600 affected some of their other credits and deductions. So that child ended up actually giving them more than the $3,600. All right, that's the child tax credit. Let's throw one more glitch in this one, or info tidbit to you. Most all of us got a stimulus letter just a few days back, and it was letter number 6475. And on it told us how much stimulus money we got back in those payments in March, April, and May of last year. Most of us were entitled to $1,400 a person. Again, if you had a child born in 21, IRS didn't know about that child. And when you're filling out your taxes, you can get the $1,400 for that child that was born in 21 because of the stimulus. So that child is now worth $5,000 plus on your taxes if you had one born in 21. So I wanted to update everybody on those, because if you've got small kids, this is really a nice year for the tax credit. On the unfortunate side, Unless Congress does something to continue it at this level, the child tax credit goes back down to $2,000 per child for 2022. So when we file next year's taxes or the taxes for 22 next spring, we'll only get $2,000 per kid unless Congress passes something between now and then and keeps it at this $3,000 or $3,600 level. Who knows what they're going to do? I'm not about to try to guess that one. All right, moving on along.
Alan, we got a question real quick. It was
Sure,
in the comment section. It just says someone received a child tax credit letter. It said both my husband and I got the letter saying $1,500. We married filing jointly. Did we get 3,000 or 1,500?
You got 3,000.
Okay, because yeah, I can personally say my wife got one letter that had 0, and I had all the credit on mine personally.
Yeah. I'm guessing that they've got 2 kids over the age of 6, and they each got would be half for the child getting the $3,000 level. So they should, you have to add it together. Sure do. Good question though. Thanks, Matt. All righty, moving on along. Tax guides. When it comes to farming, there are some guides out there that will help you with your Schedule F and all of the information related to farm tax returns. The best one, of course, is the Farmer's Tax Guide. It's updated every fall. Usually it's somewhere between October and December they get the new version listed on the IRS website. And I know that that Taylor probably emailed out this PowerPoint to you, so you've got that link that's showing on the screen. Now, there are specific instructions just for Schedule F, and we'll talk more about it in a minute. But I always say double check when you pull up anything online that you're looking at the latest version of those directions, because as tax laws change, last year's directions may not fit this year's form. So you have to be careful that anytime you're looking up something online, that you're not looking at, an article about, from 2012 or something that's 10 years out of date, because that can trip you up a lot when you're trying to do your taxes. All right, let's talk a little bit about Schedule F. And I know this is small on your screen, but hopefully it's legible or can be read at least a little bit. Schedule F is not that complicated. It's very similar to most other types of business forms that the IRS has. I'm not going to go line by line through it and wear you out with that, but I am going to point out a few issues that folks typically have with it that tends to trip them up a little bit. Number one, the top part of it's part 1 is where all the income goes pretty much. And I'll pick on a few particular parts of it in just a minute, but most of your income goes on lines 1 or 2 or line 8 for other income. And then you'll have some specific types of income that, if you get a distribution from a co-op, it'll go on 3. If you get a federal program payment, it may go on line 4, but most all of your income from farming is going to go somewhere in that top half. I will explain an exception to that in just a minute. Your expenses, all the feed, the seed, the fertilizer, the chemicals you buy, whatever else it may be, that's part 2. That's the bottom half of the form. And that's where most of your typical business expenses related to farming are going to go. There are other expenses that can be listed under line 32, and of course there's where the directions for Schedule F and that Farmer's Tax Guide helps you determine, well, what should go there. And there, there may be a variety of things that you could possibly list there as a business expense for the farm that doesn't fit specifically in one of these other categories. Let me blow up just a little bit on part 1 here, the top half of it. And I'll talk about it at a couple different times tonight. But basically, as you can see, the key things are, if you sell something, here's where all that income should go. And in some cases, the cost of that sale. And let me explain that one a little bit. I know I'll give you another example in a minute. But on lines 1A is sales of livestock and other resale items. Let's say you go to the stockyard and you buy a calf that weighs 300 pounds. And then you take that calf and you feed it a little bit and you get it up to 500 pounds and sell it. What you sold it for is going to go on line 1A. What you paid for it, the cost of it, is going to go on line 1B. And then on line 1C is the difference, which will be the actual income from the growing and feeding of that calf. So that one's kind of straightforward. Anything you actually grow on the farm, you've got a mama cow there, she has a baby calf, you keep that baby calf till you get it up to 500 pounds or whatever. It's sale of livestock that you produced or raised on your farm. That goes on line 2. That one's pretty straightforward as well. Sometimes we'll get income shown in the wrong places, and I'll give you a really good example of that one in a minute. Part 2 is, again, where all those expenses go. Not going to wear you out reading through all of this, but it covers most all of the logical farm expenses that you'd run into. And there again, you've got spaces to put some other stuff if you need it. All right. Let's talk a little bit about depreciation, because this is a topic that confuses the dickens out of folks sometimes. And we've got, in other words, how many different ways can we expense or write off the cost of assets that we use on the farm? And by assets, I can mean anything from a truck or a tractor or a cow or a horse or a goat, to anything that's, that really is a part of a major purchase on that farm. Now, one of the things the IRS did for us just 3 years ago was they now allow us to write off the expense of small equipment in the year we purchased the item. In other words, we don't have to depreciate it over a number of years. And the dollar amount they associate with that is $2,500. So if you buy a new chainsaw that costs $400, or you buy a bush hog that costs $2,499, you can write them both off the year that you buy the item as an expense on the farm. You don't have to set it up under depreciation and depreciate it out over 5 years or anything like that. So that's really nice. The catch to that one is, if you have that bush hog and you use it for a couple of years, you'd really like a bigger one. So you sell that bush hog. You got to report the income from that sale too. Since you've already got the deduction or expense for it when you bought it, and you got to report the income if you decide to sell assets. Now, you and I both know a lot of times with farm assets, that old chainsaw you bought that's now 10 years old, it's probably wore out and not worth anything. So you may sell it for, $10 or just practically give it away if it's worthless. But you're supposed to report the income of those small equipment items when you do sell them. 2 things I like to really point out here that I feel are important is the purchase of an asset should not be based on the need for depreciation or a deduction. All too often, I've heard some tax preparer say, hey, you probably want to, buy something on the farm so you get some depreciation, so it'll reduce your taxes. Well, depreciation will not pay for a new tractor. That new tractor is going to be, $25,000, $30,000 or more. And so depreciation, will save you some on your taxes by being able to write off part of that tractor or even most of it that year, but that's not going to make the payments on that tractor for the next 5 or 10 years. So you got to think about that asset, and can that new asset either increase income by giving you the ability to do more or grow more or something like that, or will it reduce labor and expenses? Is your old tractor just wore out and you're spending a bunch of money every year patching it back together and wasting a lot of time on that? And would you be better, and could you justify the new tractor that way so it would actually save you money rather than cost you money in a sense? You got to look at the whole picture. So I always warn people a little bit, think about why you're adding that asset to the farm operation. One, is it needed, and will it add to the operation in general? All right, let's talk a little bit more about depreciation.
Alan, I'm not sure, and you might be answering these questions. I'm trying to pop them up as we go here.
Okay, sure, not a problem.
You have one question or 2 questions, and one of them is, if I sell USDA certified retail beef, does that go on Schedule F?
That's a good one.
And the other one is, how does expensing small equipment differ from bonus depreciation?
I'll get to the bonus depreciation in just a moment. I'll hit it next, as a matter of fact. On the meat question, it can go on Schedule F or probably on Schedule C, because it could be considered small business. And realize you could do both. In other words, if you raise the calf that meat came from, and you're probably doing that, you can do Schedule F on the expense of raising the calf. And then you could technically sell the calf to your business that retails the meat, and have a separate Schedule C for the meat retail sales. So I think it could go all on Schedule F, but sometimes it may be clearer to put it on F and C in that case. That's where a really good accountant comes into play. Because I think you could do it, with just F, but it may be advantageous based on the expenses to put it on F and C in some cases. All right. Good ones, Matt. These folks are thinking ahead of things on tonight.
There's one more regarding that.
Okay.
Says on that same note, if I've changed the NAICS code, do I need to change, or can I switch from a few years from an F to a T? And then the following, in response to your question about doing a Schedule F and C, do you need to have an LLC in order to complete the Schedule C portion?
An LLC would not be required. It can be a sole proprietorship, just like a farm. LLC would not be mandatory for that. LLCs is a good long debate about, do you really need that, for liability protection, that sort of thing. We could have another half a night on that one, Matt. And we may want to try to throw that in at some point a little bit if I can toward the end, if you'll remind me about it. But yeah, I'm going to have to kind of back off a little bit and say, you may really want to have an accountant work with you a little bit on that one, just to make sure. But when you're retailing meat, something like that, yeah, having both and doing an LLC would not be mandatory as far as that goes, I don't think. All right. Let me hit this a little bit more on depreciation. We may get back to some of those others as I go through these examples in a minute. If you're depreciating equipment, the standard normal depreciation that you would take on a tractor or a cow is on new equipment is right now it's 5 years. Used equipment is 7 years. So in other words, if you wanted to spread the cost of that new tractor out, you would basically have a system that it would be spread over a 5-year period. Really kind of blends into 6, but it's called 5-year depreciation. For a brand new tractor. Used tractor, again, 7 years. There's a lot of equipment that fits into that 5-year classification. I'll talk more about in a second. So you have the option of spreading it out. Well, why would I want to spread it out if I had the choice to write it off all in 1 year, which we'll talk about in a second? Well, let's say that you expect to be in a higher income in the next 2-3 years. And it might be handy to have that depreciation 2-3 years from now that would reduce that income and save you on taxes, especially if you ended up in a higher tax bracket in those future years compared to getting all the break now. So yeah, there's some cases you can take the break now and reduce the income now, but there may be reasons, logical reasons, to depreciate something instead of writing it all off now. Well, let's talk about writing it all off now. How do I do that? Bonus depreciation is one of the ways that you can write the entire, let's say, tractor or cow or whatever it is you've bought that's an asset to the farm off all at one time. Right now, through this year, we have 100% bonus depreciation. Next year, it goes to 80%. The following year, 60%, and it'll go away by 2026 unless Congress changes the law or keeps it in place. Now, bonus depreciation works for new and used equipment, and there's a few catches to it. The biggest one is bonus depreciation, or the two biggest ones. Bonus depreciation is automatic. So in other words, if you buy a new asset, the IRS assumes you're going to take bonus depreciation unless you tell it you're not going to. So you've got to communicate that with your tax preparer so that they know whether or not you want to take bonus depreciation on that new asset or assets that you've bought. The other catch with it is it covers everything in a recovery class. And I'll explain that more in detail in just a minute. But for example, a truck, a tractor, and a cow are all in the 5-year recovery class. So if you had bought one of each this year, you can't pick and choose and take bonus depreciation on the truck and not the tractor, or take it on the cow and not the tractor. You can't do that. You have to take it on everything that fits in that particular recovery class. So that's one of the big catches with bonus depreciation. It's kind of an all or nothing sort of thing. Now, you may have some assets that are in different recovery classes, and you could choose to do something different with those. But everything, as you'll find out in a minute, a lot of stuff is in that 5-year class. We have one other way we can write something off, or the majority or a portion of something off, or deduct it in 1 year, and that's called Section 179. The nice thing about it is it's on a per item basis. So you can pick and choose with it whether you want to do the truck and the tractor or the cow or not. So you can choose to do one and not the other. It does have a maximum amount of $1,020,000. Not too many of us are going to run into that in Tennessee. There might be some big farms in West Tennessee that might buy some, cotton pickers and other huge tractors that will hit them over the $1 million limit in 1 year, but most of us aren't going to have that problem. But you can pick and choose with it. The catch with 179 is it cannot create a loss on the farm. So using 179 can't put Schedule F below 0, but bonus depreciation can. Why they let us do that, I don't know, but that's kind of the way it works. Now, let me show you this next table, and I know it's small and hopefully it's legible on your screen, but I put it in the order by recovery class. And recovery class is called the GDS class, or the General Depreciation System class. Now, there are other classes. There's the ADS, the Alternative Depreciation System life, which lets us spread an asset over even a longer time if you choose to. Now, that doesn't happen as often, but you can choose to spread things out. There again, if you knew income was going to be higher later on, you wanted to spread it out. But as you can see, you get past hogs and tractor units. Now, that's an over-the-road tractor, a semi-type tractor or truck, whatever you want to call it. Those are in the 3-year GDS class. And if you'll look down that list, there's a whole bunch of stuff in that 5-year class: autos, calculators, cattle, new farm equipment, goats and sheep, logging machinery, heavy duty trucks, and trucks that are what weigh less than 13,000 and over 13,000 pounds. So pretty much, ton trucks and on down are all going to fit into that 5-year class. So there's a whole lot of farm items that fit there. There's some others in the 7-year class. 2 others I want to highlight to you that are or 2 or 3 others that are a little odd. Horses are unusual because depending upon the type of horse, it may either be the 3 or 7-year class. So that's a little unusual. The other one that trips people's up on understanding is, if you look down there, the very first one that's in the 10-year class says agricultural and horticultural single purpose structure. Well, you're thinking about a barn, right? Well, it is a barn. But it's not just any barn. It's a barn or structure that only has a single purpose. That would be things like a greenhouse, a farrowing house for hogs, a poultry barn for raising broilers or eggs for sale. They typically, a general purpose barn doesn't fit there. You can't hardly get any beef barn that would work as a single purpose structure. They go down on the next third from the bottom line under farm buildings, which is a 20-year general classification. The nice thing about it, bonus depreciation is good for anything in the 20-year class and below. So, you've still got bonus depreciation as an option there with farm buildings and that sort of thing. But sometimes, you may get caught in some situations where it may be better to depreciate them or not. But single purpose structures is a pretty specific list, and you can't put a hay barn under there. It just won't fly with the IRS when they're checking that one out. All right, now I want to get into one other topic that's kind of connected to this still, but it's important about how you report something. And the reason I hit this one pretty hard is we found a lot of tax preparers and farmers putting income in the wrong place. And it can cost them money in the long run. And I've run through just a few screens here highlighting that. And it's all related to livestock sales. Now, my examples are related to beef cattle. It wouldn't matter if you're talking beef or sheep or goats or hogs or whatever it might be. If you're talking livestock, horses too, this applies to them. So basically, you've got 2 major types of sales when it comes to livestock. You got calves that you may raise on the farm, or you may buy some calves and feed them for a while and then sell them. That's calves income. You've also got breeding livestock, the cows that are out there in the herd, the old bull that, takes care of things when he's supposed to. That breeding livestock sales get reported differently than sales from calves. All of a sudden I couldn't hear. I was like, what's going on? And so and then the calves and the breeding livestock also need to be broken down a little bit further. As we was looking at that form a while ago, we talked about those calves that you raised go on one line, calves that you purchased and then resold go on different lines on Schedule F. The breeding livestock also depends on whether you raised that heifer that you're now selling as an old cow. Was she born on the farm and you kept her for a couple of years? She finally got old enough to become part of the breeding herd and then you sold her later. Or was it a cow that you bought, maybe depreciated or expensed, and then you later sold her somewhere down the road? So all of those need to be reported differently. I wrote a separate little publication called Extension Publication D42 that you can download from UT Extension if you want to, just 3 pages in length, that highlights this particular topic. And it's just about understanding the tax impact of livestock sales. But let's give you a little bit more detail on that. All right, let's go back to that part 1 of Schedule F. And we talked about where you'd report that income. So you report the income of those calves that you sell on lines 1, A, B, or C, if it's a calf that you bought, fattened up, and then resold. If it's a calf that was raised on your farm, then that income is going to go on line 2. Nowhere, let me emphasize this highly, nowhere on Schedule F do you put income from breeding livestock sales unless you're in the business of raising breeding livestock. So in other words, if it's breeding livestock that is a part of your breeding herd, that income from those sales don't go here. But if you're in the business of raising bulls that you're going to sell to another farmer, then that income would go on Schedule F because you're in the business of raising breeding livestock. That bull that you're selling is not your bull from your herd. It's a bull that you raised to sell. So that could go on Schedule F. But otherwise, the breeding livestock that makes up your herd, that income doesn't go here. And I'll clarify where it does go in just a second. We have seen it show up here. We've seen it show up on line 8. I've actually seen a tax return where it said cull cow, and they put the income over there on line 8 of other income. Doesn't go there. All right. So how do we treat the taxes related to breeding livestock? It's impacted by a variety of things. One is breeding livestock is treated just like another asset on the farm, like a tractor, like a bush hog, a truck, whatever. Breeding livestock is an asset, an income generating asset. So it depends on whether you raise that animal or where you purchased it and resold. And it depends on how long you've owned it on how it's reported. If you've owned it more than 24 months, or if it was born on a farm and you raised it and that cow became part of the herd, obviously you probably had her longer than 24 months. If you bought her and you've owned her for more than 24 months, then she fits in as the long-term classification. Basically, it's like selling any other assets, and the sale of that is considered a gain or a loss. And it's reported on Form 4797, not on Schedule F. That's the key part of this. There's some very important reasons for that. I'll get to that in just a second. But anyway, the top of that Form 4797 kind of looks like this. It just says sale of business property. And that's where the sale of all assets go. If you sell a tractor, if you sell a cow, if you an old breeding cow, if you sell other equipment, it'll all go on 4797. And all of those sales gets combined so that you have either a total gain or loss for the year from those sales. There is again, the Farmer's Tax Guide talks about this. There is instructions for Form 4797 talks about this. It's important that your tax preparer understand this as well, so they don't put that income in the wrong place. Let me give you a couple quick examples. Farmer C has a 4-year-old raised cow. They raised her from was born on the farm, raised her as a calf. They've had her for, she's 4 years old, so they've had her more than 2 years. They sell her for $1,100. They have expenses of the sale, the cost of the stockyard, the cost of hauling her to the stockyard, $125. They deduct that from the $1,100. So now they have a gain on that sale of $975. It's a long-term gain because they've had her more than 2 years. Here's the key thing. Income from sale of assets is not subject to self-employment tax. Self-employment tax right now is 15.3%. So that's the biggie here, is that income should not be taxed for self-employment tax. You may still owe income tax on that gain that you have, but it's a long-term gain, not a short-term one, which does impact it too. And that gain gets combined with other gains and losses. One more example. What about a cow that we bought 4 years ago? And we bought her for $1,300. We've had her for 4 years. She's still a good cow. We sold her for $1,250. Not a bad deal. But we depreciated that cow and took depreciation during those 4 years. We had taken $867 worth of depreciation, and we had another $125 of expenses of the sale, hauling her and stockyard cost and all that. So if you look at my little sheet there, the original cost $1,300. We add the expense of the sale. We subtract that depreciation that we've taken on that cow. So we have an adjusted basis or adjusted value for taxes of $558 in that cow. We get to subtract that from what we sold her for. So our actual gain in this example is $692, not that full $1,250 that we sold her for. Well, what if we reported that wrong? And what if we just stuck that $1,250 over on Schedule F? What does that do to us? Well, it does a couple things. Number one, in this example, I'm saying, okay, let's assume that that farmer's in the 10% tax bracket, and he's going to have to pay 10% tax on that income, and we're going to report that full $1,250 in the wrong place, and then we're going to have to pay self-employment tax because he had a net profit on the farm. He's going to go owe self-employment tax. So in this example, and it's a little far-fetched, but not out of possibility here, he could have increased his tax burden by $300 on the sale of one cow. So obviously you don't want to report breeding livestock sales in the wrong place. A few other issues related to this that's important to realize. If a farm has a loss on Schedule F, then obviously they're not going to owe any self-employment tax on the farm income. So you could take that out of the picture in that sense. But let's say you have a job in town where you're making, $50,000 a year, and your farm loss is going to reduce that tax burden on that job in town. If the sale of that breeding livestock is reported incorrectly, it doesn't reduce that off-farm income by as much as it could if it's reported correctly. So that's important. A couple other things related to this is a long-term capital gain if you've owned them for 24 months, and that's true of cattle and horses. It's 12 months for other livestock, sheep, goats, llamas, alpacas, whatever you want to throw out there. That fits in that other livestock classification. The oddity to me there is I learned just this past year that alpacas have a longer gestation period than a cow. It's 330 days from the alpaca getting pregnant to when they have the baby, which is called a cria, by the way, in case you didn't know that one. If you're not around alpacas, you wouldn't. But anyway, alpacas still fit in that 12-month classification because they're other livestock as far as the IRS is concerned. Some other real nice things to know about this is there are some other exceptions to that holding rule about the 24-month thing related to weather-related sales of livestock. Give you a quick example. Let's say that we have a drought this summer, and you've got a herd out there of, let's say 40 cows. And in an average year, you sell about 10 of them that are just getting too old or whatever reason. Your average is you cull out about 10 of those cows every year and replace them with heifers you're raising or others you're going to buy. But let's say because of this dry weather, you're running out of pasture and you're not going to have enough hay for the winter. So you decide to sell 15 of those cows instead of 10. The additional 5 that you sold because of the weather-related event, you don't have to claim the income on during the year that you sell them, and you have up to 2 years to replace them. And only if the new ones cost less than the ones you sold them for do you have to deal with income taxes at all. If you buy some that cost less than what you sold them, the group you sold, then you have to go back and adjust the taxes in that year and report the difference. It probably wouldn't be much because most likely the ones you're going to buy to replace them will cost you more than what you sold the ones out of the herd for in most cases. A couple other things related to this, that if an animal is raised with the intent or reason to be a breeding livestock somewhere down the road, and then you find out that they're sterile, that bull can't breed or that cow can't have, heifer can't ever have a calf, and you sell them within what the IRS calls a reasonable time, and I can't define what that is because they've never said, then you could sell it and consider it breeding livestock. Even though it's never had a calf or never bred an animal, you can still, because you raised it to become part of the breeding herd. You didn't raise it to become breeding livestock for somebody else. You planned on putting it in your herd. Then for tax purposes, you can still call it breeding livestock, and that saves you that self-employment tax. And also, and this one I really like for older farmers that's thinking about getting out of the business, especially if you sell an entire herd of animals, any younger animals that would have become breeding livestock can be claimed as such for tax purposes. That's just another nice little twist to the tax law that we like. So summarize this part real quick. Livestock sales need to be reported 4 different ways on your tax return. Calves you raised, calves you purchased and then later sold, breeding livestock that you raised, and breeding livestock that you purchased. And if you're reporting it that way to your tax preparer and they understand how to put it on the forms, then they'll be better able to get it in the right spot for you and save you some tax dollars in the long run. All right, moving on along some other topics I want to hit on real quick because I kind of wore that one out pretty hard.
Alan,
sure, go ahead, Matt.
One quick question here, actually a couple questions here. If their house and their land are on one parcel, is there a way to separate and depreciate them? And they didn't see where feed and vet costs were included on there. And then how would you look at chickens and bees on reporting sales?
All right, let me see if I can hit those. House and land, typically most land purchases for farm uses, the land itself is not depreciable. You can't expense it. The house you're living in, obviously you can't unless it's rental property. If it's a barn, obviously you can. There is that would be part of the farm assets that you could depreciate out over time as far as that goes. The feed, there is a line for feed, if I understood you right, Matt, on the Schedule F. So any feed expense would go there. So that was pretty, feed, seed, fertilizer, those are all on Schedule F, and those are pretty straightforward on them. Chickens and bees are like other livestock. The chickens, the cost of the chicken to, if you're trying to raise eggs or whatever you're raising there, or you're raising the chickens to sell for somebody for meat, then obviously you've got the expense of either buying the chick or the chicken itself. And that's not a problem. The bees, obviously you've got the cost of the hive and all the equipment involved with handling the honey. Many of those would fit in that small equipment classification under 2,500 most cases, unless you're getting into a big honey separator that might cost more than that you might have to either use bonus or Section 179 or depreciate. And of course, when the honey is sold, and I'll get more into sales tax in a minute, that becomes into an issue there of whether or not you have to charge any taxes on the sale of it. In most cases, you wouldn't if you're retailing it yourself. But yeah, hopefully I got those covered, Matt. We'll jump on to these other ones real quick.
Yeah, would a farm trust follow all these same guidelines?
A farm truck?
Trust.
Yeah, farm truck. Yeah, you'd be able
to. A farm trust. TRUST.
Yeah. Trust. Oh, now we're getting into estate laws. Okay, and that's a whole nother ball of wax.
Then we'll wait.
Yeah. Let me get. I'll try to touch on that. I've got a little bit on estates and at the tail end, Matt. Let me try to touch on that there if I can remember to. And farm ownership kind of fits into that one too, which is what I was about to talk about. Is the fact that a lot of folks that own the farm, often it's just a sole proprietorship. Either the husband or the wife says that's my farm, that's the way it's going to be listed, and it really doesn't matter as far as taxes goes, particularly because that's the way you fill out Schedule F is all that. Now, there's a lot of times where a couple has a partnership in a sense because both husband and wife are, they're both put money into the farm, they both put labor into the farm, they're both managing the farm. And in many cases, the way the IRS would consider that, they would be true partners in that operation. And if they are really true partners, the IRS sometimes says, well, you probably should do it as a partnership form, which is Form 1065, and it's a little bit of a hassle to fill out. And that would split up the income between the two partners. And then they do, you typically, if you think of, well, two brothers as being partners on a farm, then they would have the partnership income, and then the partnership would, give money to each of them, and then they'd do their own tax return. One of the other options a husband and wife or a couple has is they can do what's called a qualified joint venture. And that would allow each of them to do their own Schedule F. So let's say that, one partner has the chickens and bees and the other partner has the cow operation. It's still on the same farm. They could each do their own Schedule F and then combine it onto one 1040 for the tax return. And you don't have to do a 1065 form, which is a little bit of a hassle in that case. And that does typically give both of them some credit of income for Social Security purposes, as I understand it. Again, got to work with a good tax preparer on that one to make sure you're getting it right. All right, other things to think about. One of the questions I always get, especially with new farms or somebody just getting into the farm business, or even if you've been in it for a long time, what happens if I get audited? What are auditors looking for that might get me in trouble? or make them think that I'm not really trying to make money on this farm. They look a lot of times for what they call hobby farms. In other words, are you just having that farm out there to lose money to offset your job in town, or, for whatever reason, you're just not managing it like it could make money or make a profit? What do those IRS auditors look for? These are just a few of the biggies that they look for. Number one, they look for some proof of a profit motive. In other words, are you managing that farm in a means or a way that it could or should generate a profit? Or are you just, chunking money out there? One of the funny ones I read a while back was this lady that was claiming a lot of expenses for a horse operation that hadn't made money in 7 years. And she kept claiming that she was going to these horse shows looking for the right horse to buy. And she was writing off all this travel and other expenses as part of the farm expense, but she wasn't ever buying any horses. And the IRS obviously had a little problem with that. And I don't think they let her take those deductions, and probably made her pay a bunch of back taxes. Hopefully not too many penalties. So what other things do auditors look for? One, do you have something written down, some sort of a business or farm plan that says, okay, year one, I'm starting with this, year two, year 5, year 10, this is what I plan to do with this farm. Write it down somewhere, make a document, or work with one of our area farm management specialists to help create you a plan. And there's 2 reasons for that. One is, if you plan it out, odds are you've got a better chance of having a profit down the road. And that shows proof that you've thought about this a little bit, that you're just not out there willy-nilly doing something out there on the farm to have an expense. Other things they look for are, do you have a separate set of records or bank accounts for the farm? It doesn't say you have to have separate bank accounts or a separate credit card for the farm, but that shows that you are trying to keep those expenses separate and the income separate. So it's good to have a separate set of records for the farm. Again, don't have to, but it helps prove that you're trying to manage it for profit. Have you done anything to learn? Well, obviously you're here tonight, so that's continued education or training. You're trying to know more about how to manage that farm. So that goes as, the certificate you'll get from this class will prove that you're trying to do that. Have you made any changes or improvements over the last few years? In other words, if you lost the same amount of money for the last 5 years and you haven't done anything different, you're still doing it the exact same way you did 5 years ago, and it's still not making any money, they're going to look at that a little funny, obviously. And then the other thing that kind of puts the red flag up the pole a little bit, do you have a high off-farm income and the farm keeps losing money? So in other words, if you're the doctor or lawyer in town making a couple $100,000 a year, they're obviously going to look at that farmer operation probably a little bit tougher than they would one of us that doesn't have an off-farm job, or we're a truck driver not making, well, truck drivers get paid pretty good these days too, but if we're just got an average job, flipping burgers, we're not making a whole lot, and we're farming, then obviously they're not going to probably dig into our income side of it as much. But that's just a few of the many that they look for. All right, another one that's kind of a biggie, but not a real complicated one, is something we call like-kind exchange. The only way like-kind exchange works now is for real estate, land and buildings. So in other words, if you own a farm and your brother owns apartment buildings in town and he wants to farm and you want to become a landlord, y'all can swap land. In other words, swap the apartment buildings for the land. And there are some very specific rules on how that has to be done over a time frame and all that. Well, that might prevent both of you from having capital gains. In other words, if you sold your farm and bought his apartment building, you might have capital gains tax you'd have to pay on the sale of that farm. Likewise, he might if he sold his apartment buildings. But if you did a like-kind exchange of them, neither one of you might not have to deal with capital gains tax, which would be a big plus. We used to do something similar to that when we traded in equipment. You took a tractor down to the local equipment dealer and your old tractor was worth $10,000 and you're buying a $50,000 tractor, and the dealership says, well, I'll give you $10,000 for your old tractor, so I'll only charge you $40,000 for the difference. And we used to show it that way in the taxes on the papers. Well, we can't do that anymore. Now, if we trade in a piece of equipment, we have to show it on the tax return just like we sold it. So it would have to be like we sold that old tractor for $10,000. And if we had depreciated it, we might have to do what's called recapture of that depreciation and pay some tax on that recapture, because we've got $10,000 worth of income from the sale of that tractor, technically. Well, the good side of that, that's going to show up on that Form 4797 we were talking a while ago. That income of the sale of that old tractor is not going to be subject, in most cases, to self-employment tax. There might be some income tax owed on that $10,000, depending on how it shows up. Then we get to depreciate or expense the full amount of that new tractor, whether we use bonus depreciation, Section 179, or depreciate it over time. We get to put that full 50,000 there instead of the difference, the 40,000. And that reduces income on Schedule F and reduces self-employment tax. So actually, this is one tax law change that was a good one for us. It actually saves us some self-employment taxes on both sides of the picture in most cases. So that one's a good one. All right, moving on along. QBID, in case you hadn't heard of the Qualified Business Income Deduction, is another nice one that the IRS and Congress gave us back in 2018. It replaced another deduction called the Domestic Production Activities Deduction. That one was called DPAD. That one was not good for farming because most farmers didn't qualify for it because of the little picky rules that it had. QBID, most farms do qualify for. Luckily, it is an automatic 20% deduction from the profit or the taxable income. So in other words, you only end up having to pay tax on 80% of your income. It's a heck of a deal. And this is for all businesses, basically, and farmers do qualify in most cases up to a certain income level that most of us won't hit. The only kicker here is if you don't have a profit on the farm, there's no deduction because there's no way they can deduct it from zero or below zero. So that one's there. So it's out there. It's going to be around for a while, we hope. So anyway, that's just want to make you aware of that one. Other things you can do to reduce taxes, and this is just a short list, but some of them that come into play a lot of times for folks. Just some things farm-wise that might help you save on income taxes, particularly. You can prepay expenses. You can buy feed, seed, fertilizer, whatever, chemicals, whatever it might be, things, fencing even, that you're going to need the next year. So in other words, in the fall of the year, you go in October, November to the local farm supply and say, hey, I want to buy so many ton of 15 that I'll need on my cornfield next spring. Well, that puts that expense in the year you purchase the fertilizer or the seed or whatever it may be. So you get to expense it on that year's taxes, not the next year when you'll actually get the product and use it. Now, there's a couple catches to this. It must be a purchase and not a deposit. So in other words, you can't go to the farm supply and say, here's $10,000, put that toward my fertilizer bill next spring. That won't cut it with the IRS. The receipt you have for that fertilizer needs to say what you bought. It needs to say that you bought so many ton of 5, 10, 15 or 15 fertilizer. Now, that's not to say that next spring, when you get ready to get your fertilizer and put it on your cornfield, and you do a soil test and it says you don't need 15, you need 19, you can change and get something different. It just says in the rules that you've got to have a receipt that shows you made a purchase the previous year to be able to deduct it on previous year's taxes. Now, one other catch I want to throw out here. If you start doing this, realize that that year that you've now planted your corn, you've got no fertilizer expense because you bought all the fertilizer in the previous year. So now you don't have any fertilizer to deduct off your taxes, no fertilizer expense. So you're going to have to do another prepay the next that fall to have any fertilizer expense in that year. So once you start the prepaying process, you're kind of caught in a loop and you've got to keep doing it unless you have a really bad year and you don't need the deduction. Okay, throw that one out. Other ways to save money on the farm is paying your kids. Any child under the age of 18 that is your child and you pay them for a job or work done on the farm, you may have to withhold income tax because they're an employee of the farm, but you don't have to withhold any self-employment tax, the Medicare and Social Security. You don't have to withhold on that, any of that on kids. So that's kind of nice. And now I didn't say that the kid had to end up with all the money. It's just that you can put the money maybe aside or in the account for the child. And the other thing the IRS looks at fairly closely is, does the pay match the child's age and capabilities? So in other words, my examples here are, if you've got a 6-year-old, paying them $12,000 a year to empty the trash cans probably would get frowned on by the IRS. Okay. But if you've got a 16 or 17-year-old that can do everything on the farm that you can practically, paying them $12,000 a year to help on the farm, I don't think they'd worry about that one at all. That does a couple things. One, that reduces the farm income because that's an expense to the farm. So the farm pays lower taxes and less self-employment tax on their income. So it shifts the income to the child. The child has that standard deduction now. What was it? $10,000 and whatever, $12,000, $550, whatever it was. So they're likely not going to end up paying, if they do pay in, if you pay in income tax for them, they're going to get it all back. So, you know, it's kind of a win-win in some situations. I really like that one. Another tool we have is called income averaging. Doesn't come into play too often, but in the right situation, it's a real neat tool, and only farmers are allowed this one. So in other words, if a farm has a really high income year, 2021 could have been that for a row crop farm, a corn, beans, soybeans, wheat, all of those sold at excellent prices last year. Most of our Tennessee farms had great production last year, so they may have had an extremely high income year compared to 2020, 2019, 2018. Income averaging allows a farm to spread income back into a lower tax year. So in other words, it would spread it back into the 3 previous years that might have been a lower tax bracket. And that drops the income down in this high income year that would be in a higher tax bracket. Can be a real neat tool. Takes a accountant or a CPA a little while to do that calculation. Most of their software will do it for them, but they might charge you a little extra to do that. So you got to find out, well, how much extra are they going to charge me? Is it going to save me enough taxes to, you know, come out ahead? Neat tool. A couple other things don't run into too often, but it can occur. Let's say that you have a crop out there of corn and a storm comes through and blows it down. And you've got crop insurance on that field and the crop insurance pays off. Typically, any insurance payment is income in the year that you receive the payment. So if you, like I say, you've spent all that money on that corn and now you've got the insurance payment that pays for, you know, some of that cost back, you know, so you don't have a total loss on that corn crop. However, a lot of folks don't sell their crop the year that they grow it. They store it, put it in a grain bin or put it in somewhere else in storage, and they sell it the next spring in hopes of getting a better price. If a farmer can show that it's been their normal practice that that crop that they harvest in the fall, that they store it and sell it the next spring, if that's what they normally do, then they are allowed to defer or delay claiming that income from an insurance payment or a disaster payment the same way. Couple catches here. Let's say you have a disaster on your corn and your soybean crop. You can't choose to handle one way and one the other if you got to do them both the same way. So typically, you know, just little things like that you have to watch out for. Nice little thing. Not everybody runs into it, but you can. Couple other things here. Timber sales. Run into a lot of farmers that also own timberland. They own forest. And a lot of times they'll sell a little bit of it off. And if you've checked prices lately for timber, it's up from where it was the last couple of years. Major improvement from what it was back in 2019, actually. So timber sales are important and can create capital gains tax situations because it's a long-term asset. And generally it's a capital gains type sale. It can create, you know, ordinary income, but typically if you're selling it to a timber buyer or to a logger, it's going to be a capital gains type sale in most cases. However, there are ways to reduce that capital gain so that you'll pay less tax, and that's by having established a basis or a value in that timber separate from the value of the land. And what I typically say, if you buy land or you inherit land, you should very soon thereafter have somebody help you calculate what that timber's worth. It may be a forester or a forestry consultant, or somebody with the State Division of Forestry might give you a ballpark number, and come up with a value of what that timber is worth and log that down somewhere in a record so that you have a value of the timber separate from the value of the land. And that can be really important when you sell some of that timber, because that basis you've created offsets some of that gain now, kind of like that was the cost of the timber to you in a sense. I did this presentation last year to a group, got an email back from a fellow that said the farmer told him that after going, you can actually calculate this after you sold the timber. It's a little tricky, but you can do what's called a back cruise. So let's say you've owned this land for 10 or 15 years. You could hire a forestry consultant to go back and calculate what that timber was worth when you bought it or inherited it. And if it was worth enough to justify that expense of paying that person to do that, it might well be worth doing, especially if it's some high dollar timber that, is just very, very good dollar stuff to sell at some point in time. So there again, just want to mention that one to you, make sure I've at least highlighted it. Other ways to save taxes, put some money in your IRA or your 401k. If you're putting money into a traditional IRA or 401k, that saves money on taxes. You get that deduction. For most folks, you can put in up to what, $5,500 a year, $6,500 if you're over age. Is it 50 or 55? I forget. And so you can put money there. And if you're in the 10% tax bracket, if you put $1,000 in, it's really only costing you $900 because you're going to save $100 on taxes because you're in that 10% tax bracket. Now, there are limitations above a certain high income. You can't, money put into an IRA doesn't get you the deduction, but I think it's a couple has to be over, I forget now, 125,000 or more to knock you out of that one. All right, let's talk about some other taxes for a minute, then I'll jump back into some other things because I'm already taking longer than I meant to tonight. All right, property taxes, for those of you that already may know about this, but I just like to highlight a little bit because we have a whole separate video you can watch just on Greenbelt taxes. Basically, it saves you property taxes. You do this through the local tax assessor's office to sign it up. You have to own at least 15 acres to qualify. It can be two separate tracts as long as they're contiguous. In other words, they're touching each other. They're one's back to back. So you could have a 5-acre tract and a 10-acre tract as long as they're touching. The combined 15 acres would let you qualify for Greenbelt. They can't be on the other side of the county. That won't work. If you have one tract that's over 15 acres, a lot of times they'll let you connect it to a smaller tract that is not 15 acres and Greenbelt both of them. But there again, you got to work with your tax assessor on that. The state laws require that you have a state that you should have $1,500 of ag income per year. Average that over a 3-year period. Maybe you just somebody cuts the hay off of it and generates the income that way. That's what the hay was worth. That sort of thing. A couple of the key things here: it only lowers the taxes on the land. It does not affect any buildings. So your house, your barns, all that, they get assessed at the same value, no matter whether it's in Greenbelt or not. But it does significantly, in most cases, lower the property tax on the land. So that's a biggie. There's a whole manual on the state comptroller's website, and that's what's listed there at the bottom of the screen. And that link there, it goes into a lot of details about Greenbelt and qualifying. Basically, it's for agricultural land. It's also for forest land that you're not selling trees off of. Maybe you just own a forest land. Now, I've got a tract that I bought from my uncle many years ago. It had been timbered right before I got it, a couple of years before. So I won't have any timber to sell off of that tract for maybe another 15 or 20 years. But it's forest land and I can put it in Greenbelt. The requirement there is you have to have a forest management plan on that tract of land. And often it has to be updated every 10 years. Now that management plan may basically say that you're not selling any timber, you're letting it grow, but you've got to have some sort of a written plan there. And typically some tax assessors require that to be drawn up by somebody with a forestry background. Some of them aren't as picky. Just depends. And then there's an open space land that can go in Greenbelt. Most folks don't worry with that one, so I'm not going to go into a lot of details there. Other one I want to touch on a little bit is sales tax, because it's another biggie, especially for new farmers, because we can apply for and get what's called the agricultural sales tax exemption from the State Department of Revenue. There's a little form there. I've got it. There's the PDF for it. You download the form, you complete it, you mark the information on it, and you include either a copy of your Schedule F, or if you just started farming and don't have a Schedule F, you write a letter that you attach to that form that describes what your farming operation is, that you just bought this 50 acres and you're fencing it and you're going to run cattle and goats on it, or whatever you're going to do with it. You describe to them this new farming operation. And in most cases, unless you just really do a poor job with the letter, they'll accept that and send you back this cute little pocket, 2 copies of this little card you can put in your billfold or purse that you will take then to a farm supply or equipment dealer when you buy a tractor or other equipment or feed or whatever, seed, chemicals, and you won't have to pay sales tax on that because you'll have the agricultural sales tax exemption. The exemption also says you should be producing at least $1,000 of products per year to stay qualified for it. And the other thing I like to throw in on sales taxes is occasions when we have to charge sales tax when we sell something from the farm. And there is a huge manual that covers all that. Again, they're on the Department of Revenue website that talks about this. There is also some very good publications on the Center for Profitable Agriculture website that you can look up that talks about farm sales and when you have to charge sales tax. Generally, if you're selling something that you grew or produced and you have not altered it or in any major way. So in other words, again, I'll give you a quick personal example. I have a Christmas tree farm. I raise Christmas trees. I sell Christmas trees. I don't have to charge sales tax on those Christmas trees because it's a product I raised. Same thing would be said of a calf or eggs that you raise from the chickens. You would not have to charge sales tax when you sell those items, unless here's the catchers on it. If again, Christmas trees I raise, don't have to charge sales tax. I may buy some Christmas trees from another farm. I may buy them from mountains in East Tennessee, and they've got Fraser firs that I can't raise in Cookeville, and I buy a truckload of those and I bring them in and I resell them. And the question is, do I have to charge sales tax on those? The rule there is, if those items I purchased and resold are less than 50% of my gross sales, then I don't have to charge sales tax on anything. If those that I bring in and resell are more than 50% of sales, then I have to charge sales tax on them. Now, other things you might have to do, let's say that I take one of my trees I raise and I make a wreath out of it. Because that's a product of my farm, I still don't have to charge sales tax on that wreath. Now, if you alter a product or do major processing of a product, let's say that you raise strawberries and you turn that into a strawberry popsicle that you've processed now. You've done something else. It's not just a strawberry in a little cup anymore that you're selling at the farm stand. You now have strawberry popsicles that you've processed. You may have to charge sales tax on that processed item. Now, jelly is in another classification. Typically, if you only added sugar and pectin to it, then you don't have to charge it on things like jelly or jam. But there again, that's where you have to look up the specific rules on the items that you're selling. So anyway, just want to mention that to you. Sales tax is a little tricky if you're retailing things. So a really good publication at the Center for Profitable Ag, or you can check that one at the Tennessee Department of Ag or Tennessee Revenue website as well. All right. Here's where I get into my estate planning stuff. Just a little bit here as I'm winding down toward the tail end tonight. Estate-wise, there's a lot of different ways to set up estates and pass them down, whether you do it through a will or a trust or anything like that. Now, land that's in a trust, I'll try to get back to that question that occurred a while ago. If it's being farmed and it's in a trust, then that trust document says basically who owns it. In a sense, it's in the trust, but somebody's managing that expense. So you could have, expenses, deductions, and all that for the trust, but probably usually there's somebody managing that land that's actually farming the land, and that income becomes theirs in many cases. That one may get into a legal question that I can't fully answer, so I don't want to jump in too deep on that one. I don't want to stick my neck out too far because I'm not positive exactly how you would show that. But as far as estates go and the federal estate tax exemption right now, and that says 2021, I forgot to update this screen. The 2022 exemption is $12,060,000. So unless your estate, when you pass away, is worth more in 2022, more than $12,060,000, then your estate will not owe any estate tax. So most of us don't have a problem with estate taxes. And I always like to say, if you do, I'm proud for you. You've got a whole bunch of assets. Technically, a couple can protect over $25 million because that estate tax exemption is per person. So with proper planning, both of them could have that $12,060,000 exemption that would carry into the future, and that would prevent, estate taxes from ever being paid. A couple other little quick things I wanted to mention. The Secure Act back in 2019 changed a couple things, one good, one not so. The big change was if you're old enough that you have to start taking money out of your IRA or 401k, it used to be you had to start doing that at the age of 70 and 1/2. They changed it to age 72. So you don't have to take an RMD or required minimum distribution from your IRA anymore until you turn, now this is a traditional IRA, not a Roth, ROTH, Roth IRA. So age 72, you got to start taking money out of your IRA or 401k. Don't have to start it till then. Technically, you can wait until you turn 73, but then that would make you take 2 payments in 1 year. Probably don't want to do that. Probably want to start the year you turn 72. The other thing they did just this year is they changed the calculations, the factors that calculate how much you have to take as an RMD. And they actually lowered it. So in other words, they calculated that we're all living longer. They called it the longevity tables, and they basically lowered the divider that we divide into the total that's in our IRA to figure out how much we have to take out. So actually they've helped us in 2 ways on that. The negative that they did here was they changed what's called the beneficiary rules related to IRAs. The old rule was if your mother passed away and she had an IRA and she was already taking RMDs because she's over 72, the old rule was that it could become a beneficiary IRA and you could take payments out over a number of years of your lifetime. That's not allowed anymore. Basically, the general rule is a beneficiary of an IRA. So if you leave an IRA to one of your children, they've got generally 10 years to get that money out of that IRA. If it's a traditional IRA, they got to pay income tax on it, just like you would have if you'd have taken it out. So if they're taking that as one lump sum, it could be a significant, if it's a good sized IRA, it may change their tax bracket significantly. Or they can take it out each over the 10 years, a little bit each year over 10 years. They've got the 10 years to work with, and that might be the way to do it. If it's a Roth IRA or 401k, they still have the 10 years, but they could wait till the end of the 10 years because they're not going to have to pay income tax on that money because you've already paid tax on a Roth IRA. Okay. A couple other things real quick. Just talk a little bit more about record keeping. It is important. Good records help you be a better manager. Just straightforward, it helps you do things like create financial statements. So if you need a balance sheet or an income statement to show to a lender or somebody like that to qualify for a loan, really important to have good information, accurate information for that. So that's where the good set of records are going to help you. Figuring out where the money's coming from, where it's going to is important, not just for your taxes, but to know for planning purposes, what enterprises made money, which ones are losing money, which ones are the best, that sort of thing. Helps you answer a lot of questions that you may be asking. What did I really make? Have the numbers gone the direction I thought they would this year? Are they improving? How can we make it more efficient? What else could we change that might make us more money or lose us less money in some cases? You got the financial records that you're going to need to do the taxes. I mean, that one's pretty straightforward. You're going to need the dollars and the cents of what you sold and what the expenses were to be able to do the taxes, to calculate what those things really cost you or what you made income wise. But the production records can be just as important in many cases because they may help you track things like animal identification. What did the calves weigh? How many calves died? Do I have a record of really how many did I lose? How many calves didn't make it? Oh, what did they weigh when I weaned them off and I sold them? And then things like crop yields, fertilizer rates, seeding rates, tracking that on different tracts of land may help you down the road calculate which parts of the farm are making you the money and which aren't. My favorite example here is, let's say we got a pen of 25 cows standing out there and you and I are standing there leaning over the fence looking at them and you say, I need to cull out 10 of those cows. Which 10 do you think I ought to get rid of? Well, the 10 I might pick and the 10 you might pick might be totally different because we each have our own opinion of what kind of cow we like. But if we've got a good set of production records and you've had those cows for a few years, you'll have records saying how many pounds of calf did each of those cows generate for you. And that culling decision is now going to be real easy because you're going to get rid of the 10 worst ones. And that, it simplifies life going down the road. All right. Other things, conclusion here, record keeping is essential to having a good business. Good records are going to reduce, one, it's going to help you with income tax preparation cost and doing a better job on your taxes and making sure that you owe as little as you legally can. And it's also important to stay up on those tax laws and take advantage of any new deductions and credits. Not simple to keep up with, but a good tax preparer will help you with that. And I always say good tax planning helps you save some dollars in the long run. And I'll leave you with this one little cartoon that I saw a while back that I thought was a pretty neat one. With that, Matt, I will shut up because I've already went longer than I meant to. Takes me a while to get through all that.
No, well, who knows? So much good stuff there. Hey, Al, we've got a few questions here. If you don't mind, if you got a few minutes to
I've got time. If the ones I can't answer, we'll try to do what we can.
Okay. And part of that is, and I'm sitting here going, whoa, hey, that's a lot of information. Where can are there any good resources or videos that break this down a little bit further from the ground up in little sections?
I don't know of one specific, Matt, that says this is a great beginner type tax preparation type video that I know of. That Schedule F is written in a way that it's not highly confusing. I mean, excuse me, that farmer's tax guide. Yeah, granted, it's 80 some pages or whatever it is, but it's a pretty good tool to download and kind of just get yourself familiar with. It walks through depreciation and Section 179 and all those sort of things that are typically confusing. But they might give you enough of a background that between that and a good tax preparer, you can walk through. This tax software that's out there, if you're really into doing your own taxes, things like TurboTax and those other similar programs, they will help ask a lot of questions that help you plug stuff in the right place. And in many cases, but now there again, they're not farming geniuses either. That software can't be, so it can't answer everything. But yeah, there's some things out there that might help. Just I don't know if a specific video.
Okay, that's good. And Taylor, if you can make note of that, we'll make sure we include that in our email. And the good news is we're going to have Les Humple is going to do an in-person class as well. And so we'll get. And I think we've got one other person coming in doing some classes. So hopefully we'll get a little repetition, and that always helps.
That'll help.
Hearing it more than once. So quick question regarding horse boarding business and sale of hay off the property. Can that all be in Schedule C, or must the hay be in Schedule F?
I think you could go either way with that. I think you wouldn't have to put the hay in F, because if you're considering that part of your horse business and you're already using C, there may be some situations where Schedule F might give you some slight advantages, probably not with hay sales that I can't picture in my mind anything that would make it really advantageous to use F. But the only thing I can think of, there are sometimes some federal programs that you might qualify sometime down the road. And by having sales of hay in Schedule F might qualify you for them. Prime example, they put some stimulus money last year into just about every type of farming, and even specialty crops like my Christmas tree farm actually qualified for some federal funds. I never thought I'd see that in my lifetime. It just shocked me. It wasn't much, but it was better than a kick in the seat. But sometimes there are things you qualify for by having a farm that you wouldn't otherwise. That would be one of the few times I can think of that you might have an advantage of having something on F versus C.
Okay, good. Thank you. We've got another question regarding some purchasing equipment for bees, trying to purchase some of this equipment, obviously before they're a couple of years before they're ready to start producing and collecting honey. Do they want to claim those expenses until they start to get income?
There is nothing wrong with claiming them in the year you have the expense. Obviously, that's going to create a loss. But IRS understands that most startup operations are not going to make money their first few years. I give again my example of Christmas trees. It takes me 7 years to grow a white pine. So from the time I plant the seedling, I couldn't have a profit till I've got something to sell. They understand that with all types of farming pretty well. So that's usually not a problem, having multiple early years that may be a loss because you're buying that equipment to get the operation going. The only question that they might have if you try to delay taking that expense once you start selling the honey or getting the bees is your receipt is not going to match up. So your receipt's going to be for 2020 when you bought the hive, and not 2022 when you start selling some honey. So there may be advantages to going ahead and taking the loss in those first years, and like I say, they'll understand that.
Perfect. If they have a 401k during their day job, can they have kind of a separate limit for their 401k through their, if they're trying to do one through the farm?
Through the farm, there is a maximum amount that can go into a 401k, and I think it's cumulative, if I'm not mistaken. So in other words, it would have to be all your 401ks. Now, don't quote me on that one. I'm not positive. Okay. I know you still have an IRA that you can put up to $5,500 a year, I think, in separate from a 401k. but there may be, I think it's a total limit that you can put into
I
401k
think
for
it's
particular
right around
benefits.
18.5 or something like
Yeah, it's a
that.
pretty sizable amount. Yeah, that's true. It's on up there.
Okay. Let's see. I'm trying
I,
to.
I partially agree with somebody's comment that TurboTax is not great for Schedule F. They listed as horrible. It is not perfect. There is probably not any of the I guess of the software packages that most of us would use personally that are wonderful for Schedule F. It'll walk you through it, but it doesn't ask all the questions sometimes we wish it should ask. So yeah, you've got to have a pretty good base knowledge yourself to be able to put all your farm stuff into TurboTax.
I'm trying. I'm trying to work down. I think we've got. Let's see. And if I didn't get your question answered, please feel free to unmute and ask Alan directly, because I may be a poor interpreter of your question in the chat section. Let's see.
Somebody did ask about software for tracking farm financials.
Yep.
Quicken is probably our most recommended one because it's very easy to learn. It's fairly simple, fairly inexpensive. You can set the categories up in Quicken to match Schedule F. And then you can set what they call tags in Quicken up to match your different enterprises. So if you were raising corn and soybeans and cattle, you could have separate enterprises, and then you could have like fertilizer expense, and you may have fertilizer for the hay field, you may have fertilizer for the corn field, and you can separate those fairly easily with Quicken. If you've got a more complicated farm where you've got employees and labor paid, you may want to look at QuickBooks, which is a more expensive program, but a lot more detailed, more of a true accounting program, but it takes a little bit longer to learn as well. Those are two of the easier ones that are out there right now that I think of.
We got a question. Can I mix gross sales receipts of items? Example, they sell $10,000 worth of meat, and can they bring in up to $9,999 of produce
and not have to charge sales tax on it? If that there again, you've not done over 50% for the stuff you're buying and reselling, that would be, I think, fall under the state laws on sales tax, and you wouldn't have to charge sales tax on the produce. But keep good records would be all I'd say, just in case they ever did audit you.
You're being quoted and recorded on this. So.
Yeah, I know. That's why I have to dodge that bullet just a little bit there. I don't want to stick my neck out too far.
I think so. I think I've got most of the question answered. Does anybody have any questions for Alan?
If I didn't, feel free to email me later on, and I'll try to answer what I can.
Yeah,
I've got a couple questions. Is it all right if I ask those?
Sure.
Okay. One of them was, I'm not sure if I understand that if there's a difference between expensing small equipment like a chainsaw or something like that versus listing that like on Schedule F line 14 as a bonus depreciation.
Basically, there's not a huge amount of difference there. The only catch you run into, if it's small equipment that fits in that 5-year class, you're going to have to do everything in that 5-year class as bonus depreciation. Classifying it as small equipment takes you out of that restriction, as I understand it. So it doesn't matter what class it falls into. If it's small equipment that's under that $2,500 level, you can expense it and not have to worry about whether or not it would. You don't have to worry with bonus depreciation at all with those items, at least. Okay. So that helps a little bit on that one.
And another question I had is you mentioned purchasing things like fertilizer in advance, or grain or whatever. This is a specific thing that affects me. I made a deposit on some steers last year. I'm going to make the final payment this year. Which year should it be? Last year 2021 or this year 2022 that I put the total expense on?
These are steers you're buying, and you're going to feed them out and then sell them later, right?
You got it.
With those, that's an unusual one in the sense that you can't count any of that expense until you sell them. So all of the expense of those steers will go on to the year that you sell the steers. So if that's 22, then you can't claim any of that expense for that deposit that you put down in 21. Okay. Because that goes on that Schedule F of what you sold them for, then what you paid for them, and then the difference is your income.
Okay. Yeah. So I'll put it all on this year then.
That's right. Cool. That's where it'll go. Yep. I'm glad you asked that one. That is one I usually try to remember to mention. Forgot to.
You've got a question, Alan. I'm not sure if you want to. It says, for a good tax preparer, average annual cost to prepare tax returns.
Oh, wow. I would hate to even guess that one. You'll see some of these small firms that advertise they can do your return for $100 or something. I'd stay away from them. I'd run. But who knows? It depends on the complexity of the return. It's going to vary quite a bit on what they actually charge. And I haven't asked one lately what they're charging for Schedule S and all that. So I really don't know what to tell you.
Okay, we've got another one. Can we skip bonus depreciation altogether? In these early years, we're losing and spending far more than we make in years 1 to 5. We'll have a higher income in year 6.
Yes, you can opt out of bonus depreciation completely and don't have to use Section 179. So you can put those larger items on a depreciation schedule where you're going to depreciate them out over 5 or 7 years or whatever the classification is or the recovery period is for that item. You can even spread it further if you want to. Most folks don't. There's called straight line depreciation that would take an even more years to depreciate out something. But you may or may not want to even consider that. But there again, tax preparer could work with you well on that.
And just
Alan, I got another question on state sales tax.
Okay.
Well, not state sales tax. I'm sorry. That question was answered. I guess I won't have to pay. I won't have to accumulate any from my buyers because I'm not using anything other than what I've produced. But state business tax. I don't know if you touched on that. Is that something we need to pay, like sort of like a little income tax on any of our net gain?
Typically not. There are some, if you've got an LLC or a corporation, there may be excise taxes that are involved that you would have to pay. But for a sole proprietorship, there's typically not a business tax situation. We do have a few counties that have some fees involved, but without knowing the specific situation, I wouldn't dare guess on what those might be. But in most cases, we don't have a business tax that we have to deal with for farming.
Okay, well, Alan, we're kind of at the end of time. So,
okay.
But I would like to let everybody know if you have specific questions or would like us to spend some more time diving deeper in whether it's just kind of the understanding of depreciations and how you might be able to utilize those for your farm or your operation, we can certainly do that and reach out to Alan or one of our other local farm management specialists. Les Humple will visit with a little bit later this year. Mm-hmm. We'll dive a little bit deeper in there and make sure that we have a clear understanding. So please do not hesitate to reach out to Taylor or myself, and we'll either reach out to Alan or try to produce one of these things in conjunction with one of them and get your questions answered. So this has been a great night. Thank you, Alan, for all your time. And you guys have any questions, don't hesitate to reach out to us and we'll get the answers. But thank you, and everybody have a good night.
Thanks, y'all. Thank you, Alan.
Thank you. Y'all take care.
See you, Alan.